Hello, it's Jonathan Wellham of Rocklink Investment Partners, and it's May the 4th, 2017. Let me provide you just a quick overview of the current market environment, and then I want to just take a few moments to talk about ETFs, electronically traded funds. So, the current market environment, as we discussed in our last quarterly report, the first quarter of 2017, we need to be careful. It's not a time for complacency. And we say that for four basic reasons. And so let me just go through these quickly. Number one, valuations. The valuations in the market, when you look at any traditional measure of value, price earnings ratio, free cash flow yields, there's all sorts of ways that you would value the market. It's trading quite a bit above historical averages. In fact, if you just take one measure, like they call it the Shiller PE ratio, it's around 29 times. And historically, it averages maybe 17 times. So you can see that there's probably about a 70% differential between an historic average and the current average. And so that means, hey, we need to be careful. And so we are concerned about valuations. Number two, we're starting to see interest rates come up a little bit. And that's healthy. Interest rates have been too low, and zero interest rate policy is dangerous. Having said that, as interest rates come up, it should put pressure, downward pressure that is, on the valuations of stocks. And so we've seen the Federal Reserve in the United States in particular is pretty determined this year to try to get rates up a couple of times. And so, we're a little cynical, if you will, on how much rates can go up, and that'll get us to another issue, the whole issue of debt, of course. But that's what the central banks want to do. And so given that environment, hey, we want to be careful, be opportunistic. We could get some really good buying opportunities, so we keep some powder dry. Third, geopolitical risk. And, we live in a world where there's always uncertainties, there's always geopolitical risk. But I think it's fair to say that when you look at situations like North Korea, when you look at Iran, you look at the Middle East and some of the issues there, you look at South America, a number of countries that their economies have blown up, pressure in some of the African countries. There's a lot of tension around the world. And so this also can provide some challenges, some increasing volatility in the stock market, and some great buying opportunities. So that's a third issue that we're watching and very careful about. The fourth issue is debt. We've talked about this before, but global debt continues to grow at quite the pace. According to I've got the statistic here, the Institute of International Finance, 10 years ago, global debt was around 145 trillion. Now it's in excess of 215 trillion. That's a 70 trillion increase over the last 10 years. And global debt as a percentage of GDP is running at about 325%. And so the debt just keeps piling up faster than the economies are growing. And so clearly this is a big issue. In Canada, we have a federal government now that's bent and determined to run up the deficits and to rack up more debt. And we've seen that more recently as our deficit is even higher than the government's forecast. In Ontario, just to focus just a moment on Ontario, and many of our investors are in Ontario, we have a disastrous situation in our province of Ontario, a country that even 10 years ago, we had a debt of about 139 billion, and just a little over 10 years ago, 139 billion. By the year 2020, that's going to be approximately 336 billion, according to government estimates. That's a growth rate over the last, say, 15 years of almost 6% a year, over 5.5% a year. And that's way faster than the economy has been expanding. And that's with the government actually selling off assets. And so in the latest provincial budget, they talked about a balanced budget, but it's not balanced at all. There's a structural deficit of at least $5 billion. And the way that they are bridging that is they're betting on the real estate market to continue to be very frothy. And so they get all sorts of transactions, real estate transaction taxes that come in as a result of that. And also, they're selling off of assets like Ontario Hydro as they reduce their ownership there. They call that asset optimization, but basically you're selling off your assets in order to keep the deficit lower. And so in Ontario, again, we've got this massive debt problem. So this is just a symptom of what we see around around the world, really, when you look at all these different countries. So we want to be careful. That's the whole point. And so when we're approaching the market, we love the companies we own. We've had terrific reports. The companies that we own are performing very well, but that doesn't mean the stock prices can't come off. And so we want to be careful. The last point I just want to mention very quickly, and that's about ETFs, electronically traded funds. They seem to be all the rage. And I'm going to provide you with a little bit of information below. When we send out this video, we'll give you the notes that cover off some of the risk of ETFs. But they're not the panacea. They're not the solution to everybody's problems. Now, as more and more money is going into these electronically traded funds, people think they're getting a great deal. We look at that passive investing as a great opportunity for disciplined, focused, long-term investing. Now, let me just give you a couple of quick reasons why one needs to be careful about getting too enthusiastic about ETFs. Number one, you have to be careful about trading costs with ETFs. People say, well, ETFs are this low-cost alternative. Not necessarily. By the time you have to engage in the trading costs, the buying and selling of the costs, putting them in your portfolio, a lot of times you don't realize that that's an additional cost, and it depends on the trading activity within the ETFs themselves, which also could run up the cost of an ETF. The second issue I just point out, and we mentioned this in our write-up, is counterparty risk. You have to be very careful about counterparty risk. A lot of times ETFs are using synthetic or derivatives within the product, and those derivatives are dependent on who's on the opposite side of those derivative trades. And I won't get into all the nuances of that, but you don't necessarily, when you buy an ETF, own the specific asset that you think you own. You might own a derivative or a swap or some other kind of debt instrument that isn't the direct investment, and therefore you're running another layer of risk when you're investing in many of the ETFs. Also, many of the ETFs are involved in securities lending, and that means they lend out their securities to other players. And that also can create issues if there's a problem in the marketplace trying to get those securities back on a timely basis so you can actually sell them. And so you have to be very careful about what ETFs are doing in terms of trying to generate extra fees by securities lending. It can end up being very risky, especially at very volatile times in the marketplace. The third issue I'd mention is differentiated portfolios. You see, when you buy an ETF, most of the ETFs, again, are passive investments or an index. There's some big basket of stocks. You're not getting a differentiated portfolio where every stock has been selected for a very specific reason and fits into your overall portfolio. And that's why back when Nortel blew up in the Canadian marketplace, a lot of people own Nortel in index funds, or because they had to buy things that looked like the index, replicated the index. More recently, you think of companies like Valiant Pharmaceutical. A lot of Canadians own Valiant Pharmaceutical because they just owned the ETF or they owned an index. Well, our view is no, there's lots of companies in the index you don't want to own, and you don't want exposure to them. And so you need to be very careful about which stocks you do own, and by buying the index, you often get roped into companies that you would never own if you were buying them individually. The last point I just make in terms of ETFs, which I think is very important, is liquidity. That what we're seeing now is because ETFs are growing so large, they're becoming a very dominant part of the market. And so if you think about this, if you buy an ETF and you have the ability to go in and out of that ETF very quickly, if a lot of investors go into a certain sector, maybe it's bonds, high-risk bonds, maybe it's junior miners. I'll just mention a little bit about that now because there's a problem that's occurred in the marketplace more recently. But you get a lot of investors go into an investment product, they think they can get out quickly, but as they get out, that means the ETF has to sell the underlying assets. So for example, you look at bonds. Everybody goes in, these ETFs become the dominant player in a certain bond market, and then everyone wants to run out at the same time, they have to sell off those bonds really quickly. It depresses the value of the bonds. So much so that the fund might have to limit your ability to leave that fund. And so what they do is they put gates up. More recently, what we've seen in the marketplace with the junior gold and silver companies is that so many investors moved into these very large ETFs that just bought into junior miners, so that they became much too large a portion of the market. And then when everybody wanted to move out, what's happened is it's just blown up the junior miners. It's just eviscerated their value. And so what's happened is it's put tremendous pressure on the valuations, and people have taken much more volatility and larger losses than they normally would than if you didn't have all these ETFs. So my point is, be very careful about ETFs. We love ETFs, and the reason we love ETFs is the more people mindlessly invest in the market and do silly things because they don't understand their underlying assets, that creates value opportunities for us where we can sharp shoot and pick out the very best companies in an index that might have been hurt by irrational behavior of the masses, and we can accumulate positions in great companies at much more attractive prices. And that's exactly what we're doing now as we're looking at the gold and silver market, where we see tremendous and unbelievable values emerging in some of the smaller companies in that space. So there's a little bit of an overview in terms of ETFs, and we'll provide you with more information. Be very careful. When everybody's going one direction and doing one thing, in life it usually pays to go the other direction. And that's what we're doing. So if you have any questions, please let us know. And we appreciate your support. And we'll continue to trudge along, look for great companies, grow your capital, and protect your capital in the days ahead. Thank you very much. Bye now.